right. So today we are talking about liquidity. We're talking about cash, when to hold it, how much, where to hold it, what investment tools you might be able to use. We're going to talk about the risk of liquidity or illiquidity. We've got lots to cover. And this is a topic that I'm excited to talk about because I do feel like it applies to a broad range of clients. Specifically, we talk a lot about cash flow, liquidity, and illiquidity for those who are building their wealth, for business owners and entrepreneurs, and for those who are just pre-retirement or maybe have just stepped into retirement, right? That are a little bit more, let's say, inflation conscious and cash flow sensitive. So let's dive in. We've got a lot to cover today. Jeremiah, where should we get started?
Yeah. Well, I think we could start with the historic views of liquidity or what people hear in the news. So one, you hear cash is king. And anyone who's a business owner knows I have to make payroll. I have to buy expenses. I have to buy new inventory. Like there's a lot of normal operations just take cash. So cash is king. That's a normal sentiment in a business setting. When you get into a personal setting, most people will say, hey, cash is trash, or you got to be invested. Your cash is just sitting there. In fact, it's losing money because of inflation. You have to get that money working. And so there's some different sentiments between the business world and the personal finance world. But there is this, I think, deep-rooted sentiment that people feel if their money isn't invested, then it's losing, it's falling, it's being eaten away by inflation. And they're not necessarily wrong. So what do we do with that?
Yeah. And the other mindset is true too. We have some that say, well, wait, I only want to risk so much in the marketplace. I only feel good if I have X amount of dollars quite literally on hand in their home, right? It can be hidden in all sorts of interesting places. It's amazing what comes up in our client appointments. And I don't want to make fun of that mindset at all because I think that it's derived from this desire for security, this desire for access to funds, this desire to just say, what if something happened beyond my control with the banking system, right? And that reality has happened, right? The Great Depression
Right.
has happened. There's been a run on the bank. So we can't deny the fact that our history shows evidence that having some cash on hand is a valuable asset. It's just how much and, how do we diversify that holding? So I love when you talked about cash is king because it's not just about being that business owner that has enough liquidity to keep the doors open every day, but we like to think about it as opportunistic as well. So I think there's multiple
Yeah.
layers of value here. So,
Yeah.
and different opinions.
Yeah, and I think the idea of liquidity, having available cash, initially starts off as a safety mechanism. How do I keep the wheels turning? How do I withstand something? But it also is a little bit of control and opportunity. We've had a number of clients who, they get invested, they got a good structure, but then some brand new opportunity presents itself, and they don't have really the cash to move on that next opportunity. They have to go
Mhm.
back and either exit early or change things. So I think in this part of this conversation is thinking about liquidity. We're thinking about, how much cash do you want to have access to? There's a number of ways we'll talk about how to solve the problem, but just defining the problem, sometimes it's for safety, so you don't run out, but it's also sometimes for being opportunistic to say, do I have the
Mhm.
ability to move towards something new when it presents
Mhm.
itself?
So let's just start real practically. A lot of times with our
Yeah.
clients, this is one of the first things that we talk about on our agenda is just cash flow. This helps us keep our finger on the pulse, so to speak, of the household and spending. And we can find different realities. So you want to keep in your what we call operating accounts, like your checking and savings, enough in your checking account that more than adequately covers just your reoccurring household expenses. And then in your savings account, which is kind of your overflow, or some people like to call that your emergency fund. Um, let's say just kind of a range. Some people like to keep between 3 to 5 months of their reoccurring household expenses. So going back, kind of planning backwards, you have to have a sense of what your reoccurring household expenses are all in, and then do a little bit of math. And we will say that final number that you feel comfortable with to keep in your emergency or your savings account is different for every household. Some are more conservative and like to keep a higher number of cash. Some people are a little bit more risky, want to get it invested a little bit more quickly. So I'm going to say that as a range. 3 to 5 months of reoccurring household expenses is a range. And then, particularly if you're a business owner, it would be beneficial to be on the high side, or even to double the amount that you have in your savings account. So, Jeremiah, what would you add
Mhm.
to that?
Yeah, I think the we've got a lot of clients struggle with the cash because they say, okay, I did the math. I know how much I spend. I take 6 months of spending and just stick it in a savings account. What do I do with it? Because it feels like a huge number. When you're early starting out in life, most people, just to get to that, it becomes this, how do I get that much cash? But then when you have people who are building or growing, they say, I'm just going to let that cash sit there. And I think that the part of the really good layer of this conversation is there needs to be some money in a savings account that's at the same bank that you have your operating account, so that at 2 a.m., when you remember, I wrote that check, I got to move some money around, you can move it over. No problem, right?
Who
There needs
writes
to be,
checks anymore these days? Just kidding.
all right, there you go. Authorizing a transaction, maybe, right? You can move it over then. So it needs to be some amount that is so fast, so liquid, so accessible. You're probably not making much on that money. Most banks for savings accounts, less than 1%, fractions of 1% even. There needs to be
Yeah,
some there. However, the rest of that chunk that we consider your emergency fund, it doesn't all have to be in that one account. Some of it does. Some of it just needs to be liquid in the sense that even if it's invested in something that's making a decent rate, when the markets go up and down, it's not going to impact it in a major way, and you can get it within a couple of days. The reality
yeah.
is, you have an emergency, all the tires go out on your car, right? You're probably going to swipe a credit card. You're going to swipe a credit
Mhm.
card, get the new tires you need, and then you want to pay off that credit card bill in the near future. So for most people, emergencies are not, I need the money in 5 minutes. The emergency is, I'm going to need the money in the next 20 days, 10 days. And I don't want to just add debt or have to exit a major investment.
Yeah,
And so when we
yeah.
talk about this larger savings account, I almost think of like two little buckets. One bucket that's small, it's immediately there, $10,000, $15,000. It's right there. You have it. The rest of it being in some sort of an account that is not impacted by the market, but is still letting your money grow, but it's not very far
Right.
away.
So there's a lot there that you said, and I like that you're debunking that idea of like, wait a second, so I'm just going to park, let's just for round number say $100,000 in this savings account? Like, what sort of recommendation is that? So I like that you're actually like teasing it out a little bit to say like, okay, you do want a savings account that's directly connected to your checking account. So in that event that you wake up in the middle of the night and you're like, oh wait, that one expense is going to clear. I need to transfer funds so I'm not in the withdrawal, like overdrawn category and get
Yeah.
some sort of penalty, right? You want something directly connected so that you can get it almost instantaneously. But the second layer of that kind of savings bucket, so to speak, doesn't have to literally be sitting there doing nothing. And we research these, high yield savings accounts, the different rates that banks offer. Credit unions generally offer a pretty great competitive rate. So a lot of people have kind of a high yield savings account structure. But the other aspect here is that you just look at a different investment strategy for this kind of savings account. You want something that it has a short term horizon and is highly liquid so that if you needed to go ahead and put that back into your checking account, you would have access to it typically between 24 to 48 hours. And this is in response to what Jeremiah is talking about. It's something that it's a bigger expense. The tires go out on the car, you need to replace the roof. Something has happened that you need thousands of dollars and you need them generally soon. And so
Yep.
this is where, in today's market, we can look at things like laddered CDs, certificates of deposit that get a little bit greater interest rate than what typical banks are offering for a high yield savings account. You might want to look at the floating rate treasury funds, right? So these rates fluctuate with interest rates, but generally are going to give you some level of return. So you're not literally just parking these funds in a savings account.
Yeah. Yeah. And the key part of what you just said, all those things you mentioned, whether the stock market goes up or the stock market goes down, generally, those types of funds are not moving in a major way up or down, right? They're more
Right,
stable, they're earning interest. And so those funds are, in my mind, fairly secure, minimal risk associated with those. And it gives
right.
you access that type of a thing. And I think to even take a step back of, people revisit, well, why do I need this again? Like, I hear you just talked about that. Why is it, if you're a business owner, you have irregular income streams often. You might have to skip a payroll. You might have to see an opportunity to do something, right? Having this cash around. If you're a retiree, you're getting used to your income flows. We've had a number of folks they turn on their Social Security, and it takes 4 months, 3 months before they actually start getting their first checks. And so there's some concerns of just that cash flow. So having these are not just rainy day emergencies, it's also just normal operating type stuff. A big one that I see, and we see this all the time, is taxes. Someone's gone throughout the year, either the business owner or they're retired and they have RMDs coming in. And it's been a great year. They're excited. They get to tax season and realize they owe so much more than they thought they were. It's a big
Mhm.
surprise tax bill, which ideally, we've been planning along the way, but this happens on a regular basis. People will get to the end of the year, realize they have a big tax bill. And now the question becomes, how am I going to pay this? And having
Right.
that emergency fund, we talked about that amount at your same bank, it's usually not enough to really pay what they need. It is this other account though, that we said, short-term treasuries or CDs. That's a larger amount of money that you have access to for something like a one-off. Oh, I have this large tax bill. How am I going to pay it in April, or whenever it
Yeah.
comes due?
Yeah, and just a couple other things. We've had clients have situations where, let's say, they have to go on disability for whatever reason. Well, there's for a lot of those plans and benefits to kick in, there's what they call an elimination period. So typically, it could be anywhere between 2 to 5 months, 3 to 6 months before you actually start to see the benefit kick in. So that's another just real practical example of where you would rely on kind of these emergency funds. I love what you're talking about because in the example of having to pay your taxes, often the question is, well, how do I get the money to pay my taxes in the most tax efficient way possible? Meaning, do I have to pay more taxes to transfer the money from my investment account, pay capital gains, in order to, ironically, pay my tax bill? And there are some other ways to think about this. Now, this isn't right for every single client, but for some, we like to look at kind of an asset backed lending structure, and we'll break that down in a little bit, where you get to take essentially kind of a tax free loan from yourself. So, Jeremiah, there's a couple different ways to do this, but Jeremiah, do you want to talk about
Yeah.
margin?
Yeah, margin's a great one. So clients that we have, and the type of clients we work with on a regular basis, they build up accounts, whether it's a trust account or a joint account, but it's a taxable investment account that they have built up over time. It's where they're putting their savings, where they're putting their future money. And when there comes a big bill or a great opportunity, the choice might be, okay, I need a big chunk of that money to come out. I'm going to use it for something. And then they realize, just as you said, there's capital gains. Oh man, I'm going to get hit with these taxes. So one version is that we use margin. Is one of the ways that we do it is that margin often is considered an account where you're going to take a loan against the securities you have. You're going to use that money to buy more securities. That's what most people think of that as. I'm leveraging my account. Well, we often use it in a different way, that we will take a loan from someone's backed by their securities, but instead of using it to buy more securities, actually take that cash out and do pursue opportunities, pay for extreme needs, things like that. So have access to the liquidity of their investments without having to sell them, without having to trigger those taxes. And margin rates, when you are a retail investor or you have a small account, they're pretty high. They're 5%, they're 11, or sorry, they're 10%, they're 11%. They're these bigger numbers. So it's prohibitive for most folks. But as people are developing, as they're growing, as they're getting larger balances in these accounts, they start having the opportunity to take much more efficient margin. So currently, rates are changing, but currently a lot of our clients are able to get margin loans on their own account with 5 to 6%. So it's kind of like
Hmm.
equivalent to like a 30-year mortgage that, no underwriting, no security to their house, not a process, but almost instantly they can get the access to that income or that those funds and use those for other purposes.
Hmm.
Um, it's
So then
a
people
great
ask, like,
way.
yeah, like what happens, right? Like what happens next? What happens to the balance? So it's a great way to free up liquidity based on the assets you have invested in the market without having to withdraw your position in the market. So essentially, your stocks and bonds or whatever holdings you have in the portfolio stay invested in the marketplace and continue to gain interest. And in the meantime, we work primarily with Schwab as a custodian, but the custodian will honor or uphold a certain percentage of the account value of which the individual can take a loan from themselves. So it's a way to free up liquidity in a short term pinch. Now, there's all different scenarios where this applies to. The interest does start to accrue and it's added back to the balance, but there's no payback terms, meaning that you don't have to start paying it back immediately. And so that is oftentimes a benefit. Let's say that you're in the midst of a real estate transaction for an investment perspective and you need to free up some liquidity until escrow closes. Then you're going to be paid back. This is another circumstance. We have some entrepreneurs that use it for startup expenses or costs or ongoing operating expenses where they anticipate cash flow to be different in the future than it is now. These are good moments to utilize margin. Now, this isn't something that we would recommend all the time and for everyone because there is some risk involved. Do you want to explain a little bit about kind of that risk?
Sure. Yeah. Margin lending, any sort of lending, they're putting a lien on something, and here it's a lien on your securities. And if there's the unique part about a margin usage is if the markets were to dip, they come down, you can get what's called a margin call, meaning the amount of borrowing you have relative to the value of the account is out of the accepted ratio that the bank has set up or the custodian has set up. And so there can be a notice that says, hey, within the next 24 hours, you either have to put a certain amount in the accounts or sell a certain amount of securities to cover what you have. Whenever we have this with clients, we kind of have a deeper dive of talking through how this works. And we use it's kind of I guess simplistic, but a green, yellow, red strategy of, hey, if you're borrowing at this level, not a concern of a margin call. Statistically, it's not likely. You get to a yellow, hey, there's some concern. Or you get to a red to say, we anticipate if you take this much money out on margin, you will get a margin call. And so that they understand what to expect as they utilize these. But it's a great resource that a lot of clients that we work with have not considered or not used prior to working with us. And
Hmm.
then they finally understand. As we talk through it, they see where this might be useful for those cash needs. And as we zoom out a little bit, we think of when they say, "Oh, I need access to cash." There's actual cash, physical cash. There's bank accounts. There's credit cards, there's loans, there's a number of ways to make sure that a client has the liquidity that they need currently or that they may need in the future. But I think it's understanding where is debt useful, where is cash useful, where is accounts useful, and no, there's no one size fits all. Margin is not right for everybody, and I think as
Hmm.
as people maybe hear this, hopefully it sparks a new idea. But know that everyone's situation is different, and you need direct advice on what your setup is, what your needs are. It's an area of I think liquidity planning that takes some effort. It takes some planning.
Yeah.
That's important to get through.
Yeah. But yeah, just talking, broadly speaking, if you've got a client that has $5 million in a taxable brokerage account or investment account, and they're slapped with a tax bill of a couple $100,000 at the end of the year, right? It's a great way to go ahead and pay that tax bill by withdrawing tax-free money to do so, leaving the assets invested, and the interest that that account is going to earn would more than enough pay off what was taken on a margin rate. So, if
Yeah,
markets
over time.
continue to perform positively, right? So that's the risk
Yeah,
that he's talking about a little bit. So,
yep,
well, let's
yep,
move on and just talk a little bit more about risk. This is something that you touched on at the beginning of this, which is just what they call illiquidity risk. And we have a lot of people that perceive, or clients that we get in touch with, that perceive liquidity as access to credit. And actually, it's not the same. Um,
yep,
and so having, that's what we would consider kind of illiquidity risk when you don't have quick access to cash. So turning this kind of from a positive perspective, if you were entering into a deal or a negotiation and you were poised in your portfolio with ample cash, there's some natural benefits that you're going to receive.
yeah,
Um, and so do you want to kind of walk us through some of
yeah,
those benefits?
yeah. Sure. There's. I think first is almost like the psychological benefits.
Yeah.
The psychological benefit. Say if you're retired and you had a store of cash, you would know whatever that happens in the markets over the next 2 or 3 years. I've got plenty of cash. I'll be able to ride through that. Not everyone can get to that point, but we've had a number of clients that say, you can't quantify what it feels like to sleep well at night, right? To not be worried about my account. So there's psychological there.
Yeah.
The other one, I think, for a business owner or someone who's still building their accounts, the idea that if there was something great tomorrow, I could move on it. What I see as a negative actually is when people have some great investments. They put them all in there. They're excited. They've purchased a rental property. They've made this other investment, but then they see a third investment or a fourth investment, and they're scrambling to be able to take advantage and grow because they want to grow. They're growth minded. but it can get really into a cash squeeze. And we've had clients, a number of them in the past, that their balance sheet, the assets they have looks good, but we realize you are only a couple of months or weeks away from really running out of cash and everything kind of seizing up. So I think the mental mindsets of one, I'm going to be okay no matter what the market does, and two, if there's an opportunity, I can move forward on it, are really good
100%.
psychological pieces. There's a famous quote by Charlie Munger, who is Warren Buffett's investment partner. He was the attorney who worked with him for years and years. He's passed away now. But one of the things he said was the hardest part of investing was holding on to your money and skipping over good opportunities, waiting for a great opportunity. And I think that holds true when we think of liquidity. A lot of folks that are growth minded want to have their money working, want to have it deployed, which can be great. But often we want to make sure that you're holding enough liquidity, one, for your needs, but two, so that when that great opportunity, not just a good opportunity, but when that great opportunity comes around, you have the ability to move forward. That's so
Yep.
powerful.
Yep, 100%. I mean, I think about business owners and those who might be just starting out or trying to build their business. They're in a growth mindset. And we have the baby boomer population living longer than ever and now maybe starting to retire. There's a lot of acquisition, consolidation happening in the marketplace. And if you're the business owner that has ample cash to be able to leverage or go into that offer in a stronger position than the other, right? That's opportunistic thinking regarding cash. And I love what you're saying because this discernment piece there, and the part that we really we enjoy in our meetings with our clients, is being that thought partner, because there's a lot of good that might come your way. There's a lot of bright, shiny objects, but
Yeah.
waiting for the great opportunity, staying perched in this opportunistic mindset. Let's just talk about investing in general. Like, let's say that markets have a major correction, right? Are you in the position to be buying? Or are you selling, right? Are you forced to sell in a down market because you need the cash? Or rather, do you see some ebbs and flows in the marketplace as opportunity to buy low for the future benefit? That's the strength of being able
Yeah.
to have some cash or liquidity on hand for those moments.
Yeah, that's really well said. I think for anyone to take a view, say if the best opportunity I've been looking for, I've been wanting, if that came up tomorrow, could I move on it? Right? Do I have the ability, the finances to move on it? And the second, just what you said, if the market went up or if the market went down 20%, can I stomach that? Would I be buying more? Would I be investing, or would I be scared and having a problem? Like, those are two
Yep.
great kind of litmus tests for, do you have enough cash?
Yep. Yep. Awesome. Well, thanks so much for playing along today. We hope that some of what we had to say was helpful. If you have any more questions, come talk to us. We'd love to meet you, be a thought partner with you as you build the financial future that maximizes your potential and what you're up to. So, thanks so much for listening today, folks. We have a few more things to let you know about before we go. Podcast reviews really help us to serve more people and get this information into the hands of the people who need it. Please leave us a review, even if it's not 5 stars. We welcome the feedback.
And we invite you to let us know what topics you would like to hear more about, or what would benefit the people in your life who you're closest to. We have more resources online. Those resources are designed to help you share this great information easily with people in your life. To access those resources, please visit tricordatvisors.com.
Often we hear from clients that they wish they had talked to us sooner. If that's you, we'd be thrilled to see how financial planning can benefit your life. Email us at contact@tricordatvisors.com or simply click on the link in the show notes.
This show was produced by Graham Gardner at Model FA. Find out more about how to create a podcast for your financial planning business by visiting modelfa.com. We love creating content that's useful, resourceful, and maybe even a little entertaining. We want to make this mega universe of financial topics and advice applicable and helpful to your life.
Remember, at Tricord Advisors, we are your future's best ally.